Okay, so welcome back to Daily Conversations. This is Mr. K.
This is very
Yeah, and the date today is October 23rd, and the time now is 21 minutes past 6. And our topic today talking about negative interest rate. So before we start, please click the like button and subscribe to our YouTube channel. Okay, here we go. Yep, Eric.
yeah.
Yeah, okay, when talk about negative interest rate, so the
Mm,
first things in my mind
mm,
is actually the deflation.
mm,
Yep. So is this a correct uh, concept or mindset?
mm. Can you explain more? How do you link the negative interest rate to the deflation?
Okay. Yeah. To be frank, I'm not very good at economics,
Mm,
and yeah, I'm trying to find the purpose of why the interest rate will go negative,
mm,
and yeah, because of yeah, just I think because of deflation,
mm,
and um, so the it's not the government, it's the central bank, right?
yeah.
They are trying uh to introduce some monetary policy
Mm,
so that to cope with the deflation, because um usually people think that 2% of inflation is actually good for a country,
mm.
and deflation isn't a good thing.
Why?
Okay, deflation, yeah, because inflation is actually the growth, the increase of the national production. I'm not
Yeah.
sure I'm using the correct words, and
GDP growth
uh, uh yes,
from production.
sorry, bad connection.
GDP gross
Oh
domestic production.
yeah, GDP. Yep.
Mm,
So deflation is the opposite.
mm,
Yeah, and also to cope with this, so they trying to carry out this monetary policy and hope that this will um, increase the consumption of the whole society.
mm,
Yep.
mm. Yeah.
Yeah.
Uh, it's quite it's quite correct. The
Oh,
link.
yep.
Yeah. Mm,
Yeah. And then yeah, this is all my knowledge about negative interest rate. So could you elaborate a little bit more about this?
mm. Okay. Mm, okay. Uh, mm, okay. Government and central bank actually mm, have different role
Mm, yep.
uh, mm, in to cope with the economic growth. Mm,
Mm,
yeah. And on government side, this is about fiscal policy, and on central bank side, this is about monetary policy.
yep.
And when we talk about negative interest rate, we we will we will look to the interest rate first. Mm.
Mm,
Why interest rate can be negative? Mm. Because uh, in our mindset,
yeah.
interest rate as the lowest interest rate is zero. Mm.
Yes.
It become negative. Mm.
Mm,
We put money into the bank. The bank of course will pay us some interest. Mm.
yep.
Negative interest rate is it seems like we put our money into a bank and
Mm,
we need bank interest. Mm. Like
yeah.
this is like the management fee. Mm.
Mm, yep.
Mm. So, interest rate policy is also one of the monetary policy, and the economic stimulation monetary policy actually has two.
Oh,
One
okay.
is use interest rate. Another is actually open the money start the money printing machine.
Oh,
And we can call it the quantitative easing, the QE. We actually have these two types. And for the quantitative easing and or the money printing, if okay, this is a very intuitive concept. If we can keep print the money, why we need to lower down the interest rate? For example, I mean, if printing of money is so effective, and we can do this forever, why we don't just use this method enough?
Yes. Yeah, because we still either of the ways to control the interest rate or to do a QE is also actually trying to do something with the money supply, right?
Yeah. Okay. This is okay. Okay. The difference is like this. You print a lot of money.
Yeah.
And you increase a lot of money supply, and you inject the liquidity, inject the money supply into the market.
Yeah.
And people may not want to spend the money, may not invest the money.
Yep.
So the investment and the spending cannot be increased.
Yes.
Then they want to keep their money into the bank to earn the interest, or keep the money to buy some bond, like the government T-bill, treasury bill, or long term, or the government long term bond, or some other like the corporate bond. But people don't want to borrow money. People don't want to invest. Yeah, I mean, some people will borrow money for the working capital, for the working capital purpose. But they don't spend but they don't borrow money for investment, for spending purpose. So, yeah, the price of the bond, the price of the T-bill, and like the this kind of tradable fixed interest, fixed income market, the price of this asset will rise. Because sometimes this is tradable.
Yep.
So people want to save money in this, and people want to put their money into the fixed deposit. They don't want to spend. They don't want to invest. So, the central bank introduced this stimulation monetary policy. They want to they want to grow the economy. They want to cope with the deflation. They want to cope with the economic recession. But but nobody wants to spend their money. But nobody want to invest, want to do the investment. So they just keep the money. Yeah, they just keep the money.
Yep.
So this is not the central bank one. So they may come to another side about the interest rate. If the government, the central bank, they reduce the interest rate, and the fixed interest rate, the fixed deposit interest rate reduced, and the borrowing rate also reduced. So this is an incentive. This is an incentive for borrower.
Yeah.
They can borrow more
with lower cost, right?
Yeah, and based on the cost and benefit analysis, if the return, if the ROI, if the return on investment is, let's say, like 3%, and the current borrowing rate is also 3%, so there is no incentive to borrow the money to do investment. You reduce the interest rate to 2%. Now you actually have the net return on 1%.
Yes.
So this is a benefit. This is a cost and benefit analysis. The central bank incentive those borrowers. So they will borrow money, and too much money on hand, they have to do the investment, or they have to spend the money. I mean, for the individual, they'll spend the money. Otherwise, they need to pay the interest.
Yeah, but it seems that in the reality, it seems that it is not it is not necessarily effective, right?
Why?
I've done some research from the internet, and then they say that it is very hard to really evaluate the effectiveness of lower down the interest rate. And for some circumstances, when the central bank trying to lower down the interest rate, and then it still cannot encourage people to borrow money and do more spending or invest to the shares.
Yeah, it's true. Okay. Talk back to the interest rate.
Okay. Yeah.
And central bank reduce the interest rate. They want to encourage people borrow money, and actually they actually penalize. They actually penalize those savers.
Yep.
Because now saving is not good thing. You get lesser money on saving, but the inflation rate is sometimes is higher than the saving rate. So you actually losing your money if you don't spend your money now.
Yeah, Eric. For here, is it the real interest rate? Yeah, just now you mentioned about the interest rate and the deflation. Interest rate and inflation. Yeah.
Okay. Inflation. inflation is not same as the interest rate. Okay.
Mm.
But there are some linking.
Oh, okay.
Mm. Mm. Okay. So for example, you want to go for negative interest rate.
Mm.
Of course, you don't want your economy go from inflation to deflation, right?
Yep.
Yeah. So this is a simple concept. Yeah. This is a simple mindset. So you can you can get the answer that inflation is not same as interest rate. Yeah. This is just one of the very easy, intuitive mindset.
Yep.
And actually, we have another topic, which talk about the inflation, deflation, and hyperinflation, hyperinflation.
Yep.
Yeah, because yeah, just only about interest rate. This is a huge topic already.
Yes.
Okay.
Yeah.
Okay. Okay. So go back to the topic.
All right.
Central bank want to reduce the interest rate, so they can encourage the borrower to invest and also encourage the individual to spend their money.
Yep.
And at the same time, they will penalize those savers. So they don't want to save the money, and the bond yield is very low. And those bondholders, those fixed income, fixed income, I mean, fixed interest income, fixed interest or fixed dividend income, asset holder, they will rather sell their asset and switch it to like the stock.
Yep.
Or other mutual funds. And mutual funds, they also use. I mean, for individual, you may switch your fund from the fixed deposit to the mutual fund. Actually, this mutual fund manager, they use your money also invest into the stock. Okay, so what is current situation? Okay, we can see some fact. This is some fact uh, around us. Yeah, around us. I mean, it can be applied in Malaysia. I think it also can be applied in many countries.
Oh, okay.
Years ago, other country may the situation of other country may worse than Malaysia. Okay. Few years ago, I remember it is the time when I still study in university. It is like second year. Yeah, it is like second year or the first year.
Okay.
So this is about 4 years. This is about 3 to 4
3 to
years.
4 years ago, right?
Yeah, 3 to 4 years ago. So, do you know, on our banking portal, yeah, if we registered our online banking, and we have our portal, and actually, there is one function. There's one function in the online banking, in our online banking account.
Okay, what was that?
We actually can put our money into fixed deposit with one click.
Oh.
So we no need to go to the bank and tell the customer service, tell the banker that we want to save our money into a fixed deposit.
Oh.
So they'll write something, and they'll issue a fixed deposit certificate to us. So we have to keep the certificate. And maybe after 3 months or after 6 months, when your fixed deposit get mature, when the maturity of your fixed deposit have reached, you need to grab your fixed deposit certificate to the bank and tell the banker what you want to do in the next. Maybe you want to withdraw the money and put the money back to your saving account, your current account, or you want to continue to renew your fixed deposit. This is in Malaysia. This is like 5 or 6 years ago. 5 to 6 years ago. But start from 3 to 4 years ago, I actually find this function in online banking portal. So we don't need to go to the bank to do the fixed deposit anymore.
They make it easier, right?
And there are also other functions. This is like the flexi fixed deposit. So that you can withdraw your money anytime. You won't get a penalty.
Oh, how about the interest? Is it higher?
Of course, it's lower, right?
Oh.
Compared to the fixed deposit, but of course this is bigger than the
saving
interest
accounts, right?
in our saving account. And at that time, the interest rate is something like 3.3%. For the fixed deposit. For the fixed deposit rate is like 2.4 to 3%. I forgot already. And at that time, I feel this is quite low, because a few years from that time, I actually get like 4% interest, 4% fixed deposit interest rate. Yeah, like 1 year, like 1 year before from that. Yeah, 1 year earlier from that. So I was thinking, wow, how can the interest rate go down so much from 10 to 3.3%? Oh my god.
Yeah.
But of course, I still save money, like 3 months or 6 months. Yeah, because this is the money that I want to use to pay my examination fee. I don't need to pay right now at that time. So I have like 3 to 6 months. I have like 3 to 6 months time. So I want to put my money in some place can let me earn more interest. Yeah. But yesterday I go to the online banking portal. And I look at the interest rate. Can you guess about the interest rate?
For now? Okay, you mean the fixed long-term fixed deposit, right?
What do you mean long term? 1 year, 2 year, 5 years?
What, maybe 1 year?
Maybe 1 year. Okay. Okay. What's the rate?
Yeah, actually, I have no idea. Let's say 3.5.
Now it's 1.5% for 1 year.
Oh my god.
So the interest rate in this few years, maybe like in 5 to 6 years time, from 4% drop to 1.5%, and in like 3 to 4 years time, from 3.3% drop to
1.5.
drop to 1.5.
Oh, it keep dropping.
And if you keep your money like 2 years or more than 2 years, you only get 2%. Yeah, percent PA per annum in fixed deposit interest rate. 2%. 1 year is like 1.5%.
Oh my God.
Yeah. So the interest rate keep dropping. The central bank want to the central bank want to incentivize the spender, want to incentivize the borrower. But is it effective? Yeah. Sometimes yes, sometimes no. When is the time? When's the yes time? So have money. Hello.
Yeah.
When every people have money and they are very and they are very optimistic
Mm.
to the future.
Yeah, they have the confidence, right?
Yeah, they have the confidence. And on the another side, maybe they have money. They have money now. But for example, like this pandemic, everybody feel the test. Yeah. They know the feeling of of not having the saving.
Yep.
So yeah, they'll try to save more money. Even though the interest rate is low, but they want to save the money. Otherwise, maybe like 3 months later, 6 months later, they lose their job. They don't have saving to cope with that period. So go back to the fact. Go back to the Ren Qi case just now. You say this is not effective, right?
Yeah, sometimes. I'm
Previously,
not sure.
this is very effective.
Oh.
And you can look to like in uh 6 year or 8 years time period. Start from 2009.
Okay.
At that time, we just count. In 2008, we experienced the economic recession.
Yep.
And central banks around the world try to implement this monetary policy to cope with the economic recession. So it's very effective. Yeah, our economy is like on the rocket.
Yep.
And keep growing and keep growing. But when your economic size is very big, the current if you print more money, so let's say you print more 10% money, your economy can grow like 2% or 3%. And if you print additional 10% on top of that, can your economy also grow like 2 to 3%? If it can be achieved, so you can print the money forever, so you forever, it doesn't make sense, right?
Yes.
So you have to print more money to get the same level of growth rate that you have in previously. and also interest rate also follow the same concept. Okay, you reduce the interest rate, and yeah, everybody will get the incentive,
Yep.
and money. But if their debt level is already high, already high, like for example, most of people they actually have debt, credit
Yep.
credit card loan or personal loan, student loan,
Mm.
and car loan, and also the
Yeah.
house loan.
Yeah.
So, like 8 years ago, not much people have so much debt, but now they are, yeah, uh, mm, more people have higher debt level.
Mm. Yep.
So in future, mm, yeah, if the current policy still remain unchanged,
Mm.
I mean, uh, the direction is still remain unchanged. So
Mm.
we actually can expect uh, our debt level will increase further.
Yep.
But can our debt level increase forever? Of course, no.
Mm.
There has some tipping point. Okay, what's the maximum tipping point? Is actually your income cannot cover the the interest payment.
Mm.
Interest,
Yep.
yeah, and we are not talking about the principal payment. Yeah. For example, if you borrow 1 million, okay, if a
Mm.
company borrow 1 million,
Yep.
but it can only earn like mm, it can only earn like mm, let's say mm, uh okay okay let me redo the figure, yeah, because
Okay.
I want the figure to be
Yeah. Make it
easy.
easier, right?
Okay, let's say the company borrow 100 million,
Mm. Okay.
the net profit before interest and tax. Okay. Yeah. The PBIT, profit
Mm.
before interest and tax. Is also is 1 million. So the company borrow 100 million.
Mm.
PBIT equal 1 million.
Mm. So is it 1% of the borrow, the money borrow?
Yeah.
Mm.
He can only earn 1% on the uh on his borrowing.
Mm.
Yeah. So maybe his revenue is like 10 million, and he used up all the fund already, to invest into the business.
Yep.
Maybe his revenue is 10 million, but he only can earn a PBIT of 1 million.
Mm.
So if the borrowing interest rate is 0.5%,
Mm.
so uh, profit after interest you still have 0.5 million.
Mm. Yep.
Yeah, 500K. So after taxation, you still get some net profit.
Mm. Yep.
Yeah, but what if the interest rate is like 1%? So
Mm.
your PBIT can only pay the interest. 1 million pay the 1% of 100 million 100 million borrowing, right?
Mm. Yep.
So you left zero profit,
Yes.
and you don't need to pay tax, of course.
Mm.
Uh, but how about like like 5 years later, 10 years later, when the loan get expired, you need to pay. You need to pay the principal. You need to pay back the principal.
Yep.
How you pay the principal? Where the money come from?
Mm.
And yeah, some repayment scheme is based on okay. You just need to pay the interest in during the period, and you only need and when the loan gets expired, you then when the loan gets expired, then you pay the principal all in once.
Yep.
But like our housing loan, like our car loan, is actually principal plus interest, right?
Yeah, we pay it like installment, right?
Yeah. So if if on the individual aspect, if our income cannot cover the installment, cannot cover the commitment, or cannot cover the installment, so we will have the problem, right? Because we left nothing to.
Yep.
Yeah. For example, I earn 3,000 ringgit per month, but my installment per month also 3,000. So yeah.
Nothing left.
Yeah, nothing left. I have to eat glasses.
Yep.
So it's a problem. Our debt cannot grow forever. And interest rate can go to negative if the current interest rate is no longer effective to grow the economy. So the central bank is it is formed by a group of smart people. If 0% interest rate cannot grow the economy, how about we go to negative?
Yeah.
Yeah. Yeah. So this is why the negative interest rate exists. Yeah, because current because current interest rate cannot cope with the recession. If we don't do that, maybe our country will go into a deflation, will go into an economic recession.
Yep.
Yeah, so they keep reducing, and now it's 0, and they will go to negative. Like Japan, Japan actually has done this in 2014.
It is the first in Asia, right?
Yeah. And the second time, I think, is 2016 or 17. Is it? This is Europe. Yeah, you do this again. Yeah. Okay. So yeah, this is all the sharing.
Yep. Quite a complicated topic to me.
Okay,
Hello.
So do you have another thing want to add in?
No. How about you?
Yeah. Okay. So that's all for our today conversation. How do you feel? Did you enjoy the conversation? Did you learn something? Please tell us what you think of our conversation. and sometimes we may include one or two critical thinking questions in the comment. I know it's very hard to answer for most of the people, but you have quote-unquote critical answers for these critical questions, or you have your unique idea, please share it with us. And we are not native speakers. If you found any vocab or grammar mistake that we made, please also comment to let us know because we want to learn more and improve ourselves. Remember to like and subscribe to us. Thanks for watching. See you tomorrow.
See you tomorrow, guys.